Hello, Dan Passarelli here. How are you feeling today? Hope you're feeling great. In fact, I actually want to know how you're feeling. Why don't you go and hit that Q&A box and let me know how you're feeling today? That would help me know that you can find the Q&A box so you can ask questions today so you can get the most out of this as possible. What do you say? Hit that Q&A box for me. Let me know that you can hear me. Let me know. Shane is feeling great. That's awesome. Robert is feeling fine. Fine. Dominic, how's Dominic doing today? He is so excited for today. Boom, me too, man. I'm always excited for this. Nick is feeling awesome! Exclamation. Larry, getting better all the time. Yeah, man, that sounds good too. Joke says it's a great day. It sure is, isn't it? The sun is shining. Uh, uh, I feel just fine as frog hair. Wow, man. That sounds that sounds interesting. Armin is ready for action. I'm ready for action too. And Dominic, I am on a road trip making time for this webinar. That is super cool, man. You know what? I actually presented a podcast on a road trip one time. I was driving from Chicago to San Francisco, and all of a sudden my phone rings, and I answer, and it's the producer of the podcast, and she's like, "Where the hell are you?" I'm like, "What do you mean? I'm driving down there." Oh, I forgot that I was supposed to be doing a podcast. So yeah, I've done that before. But you have it easier. You just get to listen. Don't look at the screen though. Let's be safe. But listening, that's great. I listen to podcasts. I listen to books on tape. It's not really on tape anymore. What do they call books on tape now? Uh, Audiobooks. I listen to audiobooks, right, in the car. All right. So today, friends, we're going to be talking about. Oh, your buddy's driving? Okay. Well, yeah. Okay. Hand him the Doritos and Red Bull, and let's do this thing, Dominic. All right. Today, we're going to be talking about approaches to trading corporate earnings. Now, that is a big, important kind of thing. Approaches to trading corporate earnings. Hold on a second here, friends. Sorry about that. I decided that I would stand up here. Oh my gosh. And one of my cords got stuck and it started pulling everything all over the joint. All right. So today we're going to talk about trading corporate earnings. And that's a big thing. Because you know what? I don't know if you're aware of this, but sometimes trading the market can be difficult. Yeah, it's true. It's true. Sometimes it can be difficult. But what I'm going to share with you today is something that you can use no matter what the market is doing. And they're very short term. Oh my gosh. You know what? I'm going to tell you about all this stuff. I'm getting ahead of myself. I'm getting too excited. Before we get started, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. And you can get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here today is generalized information. And of course, it's not specific to your specific situation. Now, I saw some names here of participants. Let me take a look. Let me just take a look at who's here today. Hold on a second. We have a lot of the usual suspects here. We got we got a lot of the usual suspects here, but we have some new friends here as well. Who's a new friend? Go into the Q&A box and type first. 1ST. First time. If this is your first time joining us on Firstrade's as in first trade, on Firstrade's uh, Tuesday webinars. Type first in the Q&A box as this is your first time. Hey, it's Steven's first time. All right. Steven Vaccarezza. All right, my friend. Michael, third time. Okay, I am glad to see that you're back, man. Aaron, first time. Yvette, first time. Brian, oh my gosh, there's a whole bunch of first timers. Chuck, and oh, it's Nick's second time. Okay, good. Well, I'm glad to see you're back again, Nick. All right. Well, for all you first timers here, let me introduce myself. Tell you a little bit about me, who I am, maybe why you should listen to me. So, my name is Dan Passarelli, and I am a serial author. No, I don't write about cereal, but I could, but I don't. Instead, I write about, guess what I write about? I'll give you 3 guesses, and you're not going to need more than one. Option trading. That's right. I have 2 books on option trading, working on my 3rd single author book. Been part of about 3 other ones to some degree where I was quoted or whatever. And yeah, that is my thing. One of my books, Trading Option Greeks, is consistently ranked in the top 5 best option books, which is a humbling honor for sure. I also write a lot of articles, and I'm a trader. I've been a trader my whole life. Not really my whole life, but kind of my whole life. I traded baseball cards and numismatic coins when I was a kid. Um, I got all the neighborhood kids to play poker with me and won all their money. But I didn't actually start trade. Well, did start trading when I was in college, but didn't start trading professionally until after college. 1993. I know, I'm old. That's why I wear this hat, so you can't see the gray hair. Oh, geez, there's my picture with the gray hair. Oh, gosh. Well, I screwed that up, didn't I? But yeah, so I started trading professionally a long time ago, back in the 90s, and been doing it ever since. I still trade every day in my accounts. And in 2008, which is 17 years ago, holy moly, I founded Market Taker Mentoring, which is the global leader in option trader education. We have trained tens of thousands of students in over 50 countries. It was over 50 countries like 10 years ago. I don't even know how many countries it is now, but we've been doing this a long time with a lot of people. And I collaborate with good players in this industry. I've collaborated with all the good options friendly brokers out there, like Firstrade, for example, as well as basically all the options exchanges literally in the world. There's not one that I can think of offhand that I didn't collaborate with on some level. So I've been around, man. And I'm a family man outside of trading. Those of you who are market taker students, and I recognize some names who've done some of our classes or our one-on-one coaching, which we're actually accepting students for one-on-one coaching right now. If you're interested, you should email me, dan@markettaker.com. We have an application process because we don't always accept one-on-one coaching students. But anyway, those of you who are familiar and are part of Market Taker Mentoring, you probably know my wife, Kathleen, who runs operations here at Market Taker. And then I have my 2 adult children. And, if you think that once your kids turn 18, they're out of the house and, they're living on their own, you probably have another thing coming, believe me. And I do other things for fun besides trading. For example, I'm a runner. I'm a foodie, traveled all over the world, either with family, friends, or through Market Taker Mentoring. And I'm also a music person. Now, enough about me. Let's do something for you. So today we're going to talk about um, approaches to trading corporate earnings announcements. And we're going to get to talk about it. We're going to get to look at the Firstrade platform, see how we might do some of these things. I'm going to give you lots and lots of guidance, but I want to give you something to take with you. If you go to markettaker.com/earnings, that's market like stock market, taker like take what's rightfully yours, two T's in a row, markettaker.com/earnings. I'm going to give you this free ebook. It's a really great strategy guide, how to profit from earnings announcements using options, and it's designed to complement the things that we talk about here today, and it's all yours for free. So why do we trade earnings announcements? Why do I trade earnings announcements? I mean, one of the reasons is because I love it. I love trading earnings. Why? Well, because there are some bona fide advantages to trading earnings. First of all, and in a market like this, for those of you who are watching this live on what is today, April 8th, 2025, their earnings trades are pretty market independent. We don't care if the stock we're trading options on that has earnings coming out. We don't care if it goes up or down. Let me repeat that because I just said something really important there. I put on an earnings trade right before earnings. Talk more about that in a second. I put on an earnings trade, and once we get the earnings move, I literally don't care if the stock goes up or down. That's freaking crazy, isn't it? Those of you who are new to options, you might be scratching your head, go, what are you talking about, Passarelli? You don't care if the stock goes up or down? How do you make money? We do. And I'll show you. There's also very short term on each trade, which the wonderful thing about that is it limits broad market exposure. Hey, the S&P 500 is up a full percent today, down a full percent today. That doesn't have a super big impact on my earnings trade. Now, maybe if it's up or down 5%, like most stocks are going to move in sympathy with it, that could impact it, and it could help or it could hurt. But it really, like the broad market exposure is very, very limited when it comes to this earnings trading system. Are you interested yet? Yeah, you're interested. I know you're interested. There's potentially greatly leveraged profits. Now, let's combine that with the last bullet point here, very short term on each trade. You're probably wondering, short term, how short term? These are less than 24-hour trades. We hold them overnight, but that's it. We put them on today, take them off tomorrow. Less than 24 hours. And yeah, they're potentially greatly leveraged profits. You can make 25%. I mean, I have made, 25%, 30%, 35%, 40%, 50% more in some rare cases. And that's overnight. And they're freaking easy. There's an extremely simple yes/no test to screen the trades. And the opportunities are concentrated in a pretty short period of time. Now, let's talk about that for a second. Earnings announcements happen when? When do they happen? Well, they happen whenever the company announces earnings. every company does it different. They decide on what day they're going to announce earnings, and that's when they announce them. Now, about 80% of companies announce in this period of the quarter that we call earnings season plus retail earnings season, which is like for retailers, you know, like Macy's, Target, Nike. So that earnings season and retail earnings season, that's about a 7-week period. How many weeks are in a quarter? There's 13 weeks in a quarter. So more than half the time is this big glut of earnings. The other less than half of the time, there's still 20% of the companies announce earnings during that period. So this is something you can trade year round, but they're really, really concentrated during what we call earnings season. When does earnings season start? Well, it actually starts next week. Let's see here. Let me get my calendar app here. Yeah, it actually starts next week. And then it gets busier the week after that. It's really, really busy the week of April 27th. Well, actually, it's really, really busy the week of April 20th. Holy cow. So we are less than 2 weeks away from the busiest week of earnings season. And you know, that's like the first busiest week. The week of the April 21st and then 28th and then May 2nd. It's crazy. There's so many opportunities. And opportunities are the lifeblood of trading, right? You can't force a trade, can you? No, anybody who's traded for a long time, you know that. You can't just say, I am going to go make a trade today. You have to wait until it sets up. You got to wait until the opportunity is there. Well, you got about 13 days to get this system down pat before you have this big glut of opportunities. And man, you want to be ready for it. Do you want to be ready for it? Hit that Q&A box. Do you want to be ready for this earnings season when the big glut of earnings start on April 21st and goes for, I mean, really, you know, like another month and a half? Yeah. Nick says yes. Choke says yes. Dan says, you bet. Steven says yes. And it's Steven's first time here. Yvette says, of course. Michael says, faux show. And I am with you on that one, man. Ryan says, let's do it. Yeah, I agree. The prepared mind, right? Larry's ready. The prepared mind. What is that quote about the prepared mind? I don't remember what the exact quote is, but you know, you want to take advantage of opportunities, you got to prepare your mind. So, before we get into exactly how this works, I'm going to share a story. Do you mind if I share a personal story with you that can tell you exactly how this whole earning system that I developed came to be? Give me a yes in that Q&A box. You mind if I share a quick, short, little personal story? Yeah. Okay. So, all right. It's okay with Larry. He says do it. So this is, I don't know, it was probably like 8 or 9 years ago. Okay. Long story short, I find myself on the phone with a producer from Bloomberg Television. And the producer says to me, Dan, we want to put you down in the trading pits. You know, you used to stand in the trading pits. You're going to go down the trading pits, and we're going to interview you about you know, stuff that's going on in the markets. And this was like my first time going to be on global television, so I'm like, okay, this is great. Yeah, I was pretty excited, right? What do you want to talk about? He goes, okay, Dan. So this is what we want to talk about. Apple has earnings coming out after the close. We want you to give our viewers a trade idea in how to trade Apple going into earnings. And then, do you know what happened? I said, oh no. I didn't actually say, oh no, but I thought to myself, oh no. And so I said, hey, listen, let me call you back in 5 minutes. It's kind of a weird thing to do, right? Why did I do that? Because, and you probably don't know this, but most professional traders don't trade earnings. Really. At the height of my professional trading career, I was one of the top 5 traders in my entire company as far as profitability goes. And there were about 50 traders. I was in the top 10%, top 5. My boss at that point would have let me trade anything I wanted with the company's money, as big as I wanted. He trusted me that much. But do you know what I was never allowed to do? I was never allowed to carry a position going into earnings. Why is that? Because earnings is the most unpredictable day of the quarter. Nobody can predict direction on earnings. I mean, even if the stock beats the company's earnings beat analyst expectations, a lot of times the stock still goes down. It's not as good as the whisper number, the secret whisper number, whatever people are expecting. You just can't predict it. Nobody can. Anybody who tells you they can they're lying to you. It's not true. So I was like, oh boy, so what am I going to do? If I'm going to go down on the trading floor to be interviewed by, top reporter here, like my friend Abigail Doolittle here next to me, I'm going to talk about a trade that I have on. It's just a moral thing with me. Those of you who know me, you know that I put my money where my mouth is, right? If I'm going to talk about a trade in front of hundreds of millions of people, it's going to be a trade that I have on that I'm committed to. So I went to my trading computer and I started looking for trades. I was like, well, I can't buy calls and I can't buy puts, obviously, because those are direction. Can't buy call spreads or put spreads. I can't sell call spreads or put spreads. No debit spreads, no credit spreads. I can't do covered calls or cash secured puts. Oh no, what am I going to do? Do I got to call the guy back and say I can't do it? So I kept looking. And finally, in my last ditch effort, I looked at a time spread, also called a calendar spread. And I said, wait a minute. This is actually a great trade. So I immediately put the trade on, called the guy back, went down to the trading floor, did the interview. The trade worked out. I made money, and the rest is history. Now, I came across some data a little bit later that I'm going to actually show you in just a minute, that then gave me the black and white proof that this was no fluke. When the right criteria are met, this is a genuine consistency trade that can be used over and over again to crank out consistent profits during earnings season. So, tell me about this, Dan. What are we going to be looking at? So, I'm going to give you a little crash course here in time spreads and in straddles. If you already know these things, it's only going to take about 65 seconds, so hang tight. Then I'm going to show you some stuff that's going to blow your mind. So a time spread is when a trader buys a call and then sells a different call that has the same strike price but less time until expiration. Now, this could also be done with two puts: buy one put, sell another put, same strike, but you're selling the one with less time till expiration. Now, the data show, and honestly, that's the only thing you need to know. Like, outside of that, everything's easy. The data show that these time spreads, a lot of the times, they can work out really, really great, as you're going to see on the next slide. But that's when certain criteria are met. And that is very, very, very important. I'm not saying, yeah, just, oh, yeah, every time before earnings, just go sell it or buy a time spread. It'll be easy. No, that's not what I'm saying at all. But when certain criteria are met, time spreads can work out really great. But other times, when a different set of criteria are met, we use straddles and even sometimes some other strategy, but usually it's time spreads or straddles. Those trigger maybe less than 5% of the time. Usually, I think this earnings season, we might be using them a little bit more, 10% of the time, maybe. So let's talk about the tried and true that has served me pretty well over the years, time spreads. And if we have extra time at the end, we'll talk about when we use straddles as well. So let's take a look, shall we? Now, there's a lot of data here. Don't get too hung up on trying to read all the numbers. Later, actually in just a bit, I'll explain how to simplify all this. For now, here is what is important. If you sell short-term options the day before an earnings event, they lose value greatly once earnings are announced, which is the next trading session, which is good, right? Why is that good? First of all, who can tell me this? Why do they lose value and why is that good? If I sell options the day before, short-term options, the day before an earnings event, why do they lose value greatly? And why is that good? Dominic, boom. Dominic says IV drops. That's right. That is exactly right. IV, for those of you who don't know what Dominic's talking about, is implied volatility. And yeah, implied volatility drops, which some people will call the crush. Herman got it also. IV comes down after the announcement. Great job, both of you folks, both of you gentlemen. Okay, so far so good. Now, longer term options, they also lose their value between putting them on the day before earnings and then after the announcement. But the key element of this observation is that the short-term options lose more value than the longer-term ones. So what this means and what this essentially proves is that when certain criteria are met, trading time spreads around an earnings event is effectively a long-run consistent winning strategy. Okay, now, I don't know. I know some people who are really new to time spreads. This might be confusing. So let me ask, whether you're experienced or novice, what are your thoughts on this? Why is it arguably bad that these options that we're buying in a time spread lose value? And why is it still okay because the time spread can make money? You kind of have to think about this one a little bit. Why do the long-term options lose money? Why does that cost us? I'm kind of answering my own question a little bit here. But why could the time spread still make money? It's a tricky one, right? I'm just going to tell you, because we're selling the short-term ones and they lose value and that's good, but we're buying the long-term ones, they lose value and that's bad. The short-term ones lose more value than the long-term ones. Now, you might have a logical question here. You might say, well, Dan, why do we buy the long-term ones? We do it for a hedge because if you get a really huge move, you can lose a massive amount if you're just selling a naked straddle or something. But if it's a time spread, you have limited loss. So basically, when certain criteria are met, these work out really, really great, and you can see the results down here. So let's talk about how this works. These are basically the steps to follow throughout earnings season. There's a few details involved, but this is basically the gist of it. So I need you to write this stuff down. Okay. First, we find all the stocks that have options listed on them and then have earnings coming out after the close today or before the open tomorrow morning. Are you with me? Yes? This is important. You following me? Where do we get this information? JFGI. You know what that stands for? Just frickin' Google it. Google it. It's out there on the internet. Yahoo Finance will tell you when every stock in the world is announcing their earnings, what dates, and if it's after the close AMC or before the open BMO. When we do this, when we're doing this part of the research, we're doing it for today. Does the stock have earnings coming out today after the close or tomorrow before the open? Yes. Okay, this is a potential candidate. Now, we can find several trades a day, and sometimes there are literally hundreds of opportunities. For example, the week of April 21st, there are literally hundreds of companies announcing earnings that week, and the week after, and the week after. Now, they're all not decent candidates. In fact, very few of them are. We have to continue to whittle the candidates down from hundreds to only the best of the best of the best, which is what we want to do as a trader, right? You could go make 100 lousy trades, or you could skip all those and only make the best trades. Which one of those choices sounds better? Make 100 crappy trades or 5 really solid trades? 5 really solid trades, right? So we're going to whittle that down. And one of the ways we whittle this list down is, first of all, we use the yes-no screen technique. Now, there's not a lot to this. It's pretty simple. It has to do with reading the implied volatility of each option. But I know there's some new folks here, and I know there are some folks who already understand implied volatility. And I know there's some folks here who do not understand implied volatility. So I'm not going to get deep in the weeds with that. I'm not going to get super deep in the weeds with number 3 either, calculating the modeled endurable gap. Okay? If you do step 2 and step 3, this will whittle the list down to a manageable handful. It'll whittle the list down to only the best of the best trades. And this will literally save you hours and hours and hours of your precious time and make your life just a lot better, right? Not to mention, it'll ensure you're only trading the best of the best trades, which are the ones with edge. What does edge mean when it comes to option trading? It means you have a statistical advantage in your favor, which means your win rate increases and your winners are bigger, right? You like that? Yeah, I do too. So we only continue on with the trades that have what we call a positive term structure of volatility. And the greater the disparity in the term structure, the better. And that is a critical step. And this is something that I learned on the trading floor. And I traded it basically every day. And then when I created this earnings trading system, I added that component to it. And it makes it really, really simple for anybody to follow. So next, we run, I call it the is-was check. The is-was check by modeling the spread on tomorrow's days with the variant vol crush on both the short-term and the long-term option based on a partial reversion to the mean, but also relative to realized volatility. And the idea is we're going to compare that to the past to get the modeled and durable gap. Okay. And once you have that, you know exactly which trades to put on and which to stay away from. I actually created a spreadsheet that like lists all the steps. You just add, boom, the stock price, the volatilities, the crush, the thing that I call the haircut, the break evens, and it just the gaps, and it just tells you, do you make this trade or not? It ends up being really, really easy. I know it seems like there's a lot to this, and there kind of is. There kind of is. But definitely download that ebook that I gave you earlier. What was that? markettaker.com slash what? What was the web address that I told you guys to go to? Anybody remember? markettaker.com slash what was it again? I forget. I got a couple of ebooks out there. Earnings. Oh, that's right. Thanks, Yvette and Larry and Dominic. markettaker.com slash earnings. Right. You go there, you grab that ebook, and I talk more about some of the stuff in that. And once you download the ebook, we're actually going to send you an invitation to a webinar we're having next week, which is all on earnings. And I go deeper into this stuff and give you an opportunity to go forward with this. Now, this part that I'm going to talk about next, this is where most people go wrong. I put on the time spread, the trading session immediately before earnings. So what does that mean? If earnings is today after the close, I'm going to put it on today. Today is the session before earnings. If earnings is tomorrow before the open, I'm going to put it on today. Today is the session immediately before earnings. If it's tomorrow afternoon, well, I'm going to put it on tomorrow during the day. And I'm going to take it off the next day at the exact right time. This is less than a 24-hour trade. This is the shortest trade that I trade. And that's critical. Then we follow the MTM proprietary earnings trade technique, this whole thing that I just shared, and exit the trade at the precise time the following day. And, a lot of people screw this part up. But I'll share with you how you can get the timing right. Grab that ebook at markettaker.com/earnings and attend the follow-up webinar too. So let's go through an example. So let's say I go to Yahoo Finance. I look at what companies have earnings coming out after the close today or before the open tomorrow. And there's a company that maybe I never even heard of. The name of the company is Wanda's Extra Yarn and Zippers. It is a startup secondhand craft supply store. Wanda's Extra Yarn and Zippers. Stock symbol WXYZ. Well, it turns out they have earnings coming out after the close today. And I go through that whole big list that we just looked at a minute ago. And wouldn't you know it, it signals this trade here. And so just look at the top part here. Okay, here, let me circle it here for you. Just look at this part right here for now. Okay, fair enough. Whoops. WXYZ has earnings coming out after the close today. I go through that list of steps that I just shared with you, and it triggers this trade. So I trade this time spread. This time spread is selling the WXYZ April 17th 57 puts at 81 cents, and at the same time buying 20 of the WXYZ May 2nd 57 puts at $1.36. Now there's a number of things going on here that we need to address. The first thing is this expiration is going to need to be the one that expires immediately after earnings. So if today is Tuesday, which is always the day that we do these Firstrade webinars, so please mark your calendars to make sure you attend these every Tuesday at noon Eastern time, which is 11 o'clock Central, which is 9 o'clock Pacific. Make sure that you attend these. But if today is Tuesday and the earnings announcement is today after the close, then, and there's weekly options, which expiration do I want to sell? I want to sell the one that expires this Friday. So we're just kind of pretending that this Friday is April 17th, okay? It doesn't really matter. And then we're going to buy a further out option that has the same strike. They're both either calls or they're both either puts. In this case, I chose to use puts. The one that has more time until expiration is going to have more value. So I'm buying the more expensive one, selling the cheaper one. So net, I'm paying a debit of how much? Well, it's $1.36 that I'm paying, 81 cents that I'm collecting. 136 minus 81 is 55 cents. Bingo. All right, let's get rid of that line. Now, the market closes. After I put this trade on, the market closes, right? And then earnings comes out and they have their conference call. And it's good news or it's bad news or it's medium news. It's whatever it is. And the stock goes up a little or it goes down a little or it goes up a lot or it goes down a lot or it stays unchanged. It does whatever it does. Doesn't much matter as long as it doesn't move too much. And we have ways to measure how much we expect it to move. And as long as we think it's not going to move too much based on the modeled endurable gap, we would have made the trade. And in this case, let's say it moves some, kind of a lot more than an average day, but not enough to cause us any trouble. So we close the trade the very next day. And we close it just by reversing what we did yesterday. Yesterday, we sold 20 of the WXYZ April 17th 57 puts. And today we're going to buy them, buy 20 of the WXYZ April 17th 57 puts. And yesterday we bought the May 2nd 57 puts. So today we're going to sell the May 2nd 57 puts. And we're going to buy these at 14 cents. We're going to sell these at $1.04. That comes out to 90 cents. Okay. How much profit in dollars would this trade have made? Who can tell me that? How much profit in dollars would this trade have made? Anybody know? Can anybody tell me? 900? You're all giving you're all giving the answer, but to just slightly different questions than what I asked. Dan, you're right. You collect 90 bucks times 20 contracts. Justin and Nick and Steven, you're right. You make 35 cents a contract. 90 cents minus 55 cents is 35 cents, which is $35 of money times 20 contracts. So the big winner today is my friend Nick. Nick guessed 700 bucks, as did Justin. You guys are the big winner, and you win a brand new piece of pride. That's right. Honor. You win honor. What's better than honor? No material possession is better than honor, is it? Of course not. You win the honor, Nick. And Justin, runner up. Justin, always a bridesmaid, never a bride. Got to be a little faster next time, Justin. But you got the answer right, which is great. Okay, so all this being said, you made you didn't make, but a trader could have made like 700 bucks making this trade. And how much was actually risked? 1,100 bucks. When's the last time you made a trade? Did you invest more or less than 1,100 bucks in it? It depends how big of a trader you are, right? I would guess that if every single person here answered that, more people would probably be a little bit below 1,100 bucks. Some people would be around there, and a good number of people also would your last trade would have been more than that. So not a huge trade, not a tiny trade, but not a huge trade at all. And pretty darn good rate of return on this, right? It's a hypothetical trade, but this is how it works. Now, the key here is consistency, because I'm going to tell you something. That's a nice profit. Hypothetical. Actually, now that I'm thinking about it, I made those numbers up yesterday. That would be towards the higher end of profitability, I would say, for sure. I was just looking at this yesterday at some trades that I have made before, that I'm putting in the presentation I'm going to do next week, that you'll get an invite to if you download that ebook. And I had like a 27% winner, 35 point something percent winner, 37% winner, 40% winner, and then, some 7% winners. And does every trade win? No. And that's important to understand as well. There's no trading system where every trade wins. But here's what I like about this. You have limited loss. You have a high probability of success, and the trades are pretty manageable. So Vince says, what's the risk for this trade? And how do you sort out the profitable and safe ones? Great question. So what is the risk? When it comes to trades like this, that's like saying, what's the risk of walking across the street? Well, I mean, the risk is you could become a pancake, right? Get run over by a garbage truck. And that's a thing that people say because it's probably happened before. People walked across the street, garbage truck comes by, next thing you know, you're a pancake. And not the delicious, tasty kind with maple syrup on it, the kind you don't want to be. So the most you can lose is what you pay for this trade, 100%. But you know what your risk is going in. This is how it is with a lot of responsible option trades. If you buy a call, you can lose 100%. Most of the time that you have losers, you're not going to lose 100% unless you're just not doing a good job managing the risk at all. You manage it. And I would say a fair number of my losing trades, and I'm just thinking from memory here, 3%, 7%, 15%. Sometimes you get those 22% losers. It's not often where you have a 100% loser. And for me and for our students who trade this, we have a high winning percent as well. So it is important to understand what the max risk is. The max risk is what you pay for the trade, but seldom will that be a thing. In what scenario does it turn bad? It turns bad in the scenario that there's just a way bigger move than expected, way bigger move than you've seen in the past. Just something completely out of the ordinary happens. And this is trading. Out of the ordinary things do happen sometimes. It's kind of like almost like a bell curve, or it's actually technically a log normal distribution with fatter tails. For those of you who are knowledgeable of statistics, called leptokurtosis. What that basically means, though, is most moves are small. Some are a little bigger. Some are even a little bigger. But there are a few that are very big moves. Those are the ones that bite you in the butt. So realistic expectations, how often can you find trades like this? I mean, literally the week after next, maybe even next week. I mean, there's going to be hundreds of trades. I mean, the S&P 500 is about to start announcing. The Russell 2000, like there's going to be a ton of trades being announced. The risk reward is decent, and it's possible for highly leveraged profits with low and defined risk. What if the trade doesn't work out? They're definitely not all going to work out. Some are going to lose. But it's limited and, more importantly, manageable, and it can be just a small fraction of possible gains. Now, holy cow, we're pretty much out of time. So that being said, I gave you this link earlier, markettaker.com/earnings. Get that, grab the ebook that goes along with this. If you do, I'll send you a link to the webinar we're having next week that goes deeper into this. Nick asks, how far out should the second option expiration date be? It's typically anywhere from 2 to 4 weeks. It's usually 3 or 4 weeks. There's a little bit of nuance that goes into that. Let me just say 3 or 4 weeks. Rule number 1 is you never want to go out more than 30 days. Okay. Rule number 2, you want it to have tight bid-ask spreads, and then there's a couple other rules, but those are some important ones. All right, friends. That being said, have a great rest of your day. Michael, you are welcome, my good friend. Nick, you are welcome, my good friend. All of you are welcome, and all of you are my good friends, except for that one guy. I don't know what that guy's problem is, but the rest of you are my good friends, and I'm going to see you in exactly 1 week minus 1 hour from right now. See you, Yvette. See you, Dan. See you, Larry. Bye, bye, bye. Ciao, ciao, ciao. Adios, adios, adios. Au revoir. Bye, folks. See ya.